to this, my second data update for 2023. And in this session, I'd like to talk about what stocks did in 2022 and focus on US stocks in this post, but we'll come back and talk about global equities in the next few. Now, if you were an investor in US stocks, you know it was a bad year. You're probably trying to forget the year, but equities have good years and bad years, and far more bad years than you realize. And sometimes we forget about the latter during market booms and hope that we will never see a bad year. But I do think that markets have bad years just to send a reminder to investors that risk is not an abstraction, that stocks don't always win, even in the long term. So 2022 was a reminder, and I think we needed that reminder more than ever before because we'd come off a decade of excess. You're going to see the returns we made between 2011 and 2020. And in the aftermath of COVID, especially starting in March of 2020, when stocks came booming back, there were some people who concluded, hey, stocks never stay down. They always bounce back. So what I'd like to do in this session is actually talk about what stocks actually did in 2022. And it's not going to be pretty, but I also want to talk about what that has done to expectations for the future and how it's playing out and where the market is today. So let's start by looking back at 2022. And as I said, I'll focus this particular session on US equities and particularly large cap US equities by looking at the S&P 500 by month during 2022. So if you look across the year, we started the year at 4766 on the index. We ended the year at about 3840. We had some good months. If you look at October, we were up 7.68%. In November, we were up 5.37%. But also a lot of bad months. June was one, as was September. Over the course of the year, we had more bad months than good months. And in fact, if you compute the annual return that you'd have made on the S&P 500 during the course of 2022, it's worth remembering that there are two ways you make money on stocks. One is dividends. And of course, if you're a safety-conscious investor, you seek it out. But dividends are always going to be a small part of overall equity returns. To show you how small they look in 2022, the dividends paid by all of the companies in the index amounted to about 1.41% of the index. But 399 companies out of the 500 paid dividends, 101 don't pay dividends. Some pay tiny dividends, some pay bigger dividends. But collectively, dividends accounted for a 1.41% return. Now, you already saw the price change, right? From 47.66 to 38.40. That's a drop of 19.42% in the index. Overall, the return in 2022 on the S&P 500 was minus 18%. Bad year, right? But how bad in historical context? To answer that question, I went all the way back to 1928. This is one of those data sets I maintain on my website. If you're interested, you can download it. And I looked at the annual returns on stocks over 95 years, which is my historical time period here. And I drew a histogram. Histograms are not fancy. I just count the number of years where I get returns which are worse than minus 25%, or higher than plus 25%. And you can see the distribution here. First, the good news. There are more good years than bad years. But in 26 out of the 95 years, I had negative returns. It's not uncommon for stocks to have negative years, and sometimes really bad years. In fact, there have been 5 years where the return on stocks, this is including dividends, has been minus 25% or worse. Minus 18% is at the tail end of the distribution. This is a bad year, even in historical context. To get a better sense of how bad a year it was, I ranked the worst years in the S&P 500's 95-year history, and 2022 was the 7th worst year if you looked at the total return in nominal terms. This is the return we tend to look at. Now, remember, the return you actually keep is return after inflation, a real return. And in real return terms, 2022 was an even worse year. It was the 6th worst year because 2022 also brought inflation with it. Now, in the other table to the right, I've also computed returns by decade. There have been some bad decades, 1930s, for instance. The cumulative return over the entire 10-year period on stocks was 8.7%. You made 0.84%. a year. But because there was deflation in some years, your annual return worked out to be 2.19%. And if you look across the decades, you've had some good decades, the 1950s, the 1990s, and of course, the last decade, 2011 through 20, where stocks in both nominal and real terms have delivered really rich returns, double-digit returns. We haven't started this decade well. It's very early in the decade. I'm not going to pass judgment about the decade, but in 2021 and 2022, the nominal return on average across the 2 years is 2.6%. It's a geometric average. But after adjusting for inflation, it's been minus 4.18%. You have some digging to do to get out of this hole. But the first 2 years have not been good years. So that's about looking at the past, and clearly coming into 2023, looking at the past is only going to make you depressed. Investing is about the future, though. So let's talk a little bit about expected returns. And I know actual returns do affect expectations, because if you have years of bad returns, you might say, well, my future returns are going to be lower as well. But if you're investing for the future and I ask you what kind of expected return should you make on stocks, let's put some constraints on that number. Say the risk-free rate is 4%, and I come to you and say, how much would you need to invest in stocks? If you're rational and logical, and those are both rare traits now, I guess, you're going to say, I need to make more than 4%. Do you see why? Because if you can make 4% guaranteed, why would you settle for less than 4% for investing in something risky? You might get disappointed after the fact, but going in, you should expect to make more than 4%. How much more? That extra premium you charge over and above the risk-free rate is called an equity risk premium. Now, it's a central number that you need when you value companies, when you're in corporate finance. And we face a problem in practice. You can't observe the number easily. Unlike a bond where you can see the interest rate, investors don't telegraph what kind of equity risk premium they demand. So the way we've taught people to estimate equity risk premiums, the way it's often estimated in practice, is by looking backwards, by looking at what's called a historical equity risk premium. What's a historical equity risk premium? Let me give you a very simple example. Suppose I took the last 50 years and I looked at what I'd have made investing in stocks on average. I'd have made about 10.24%. Over the same 50 years, if I look at what I'd have made investing in bonds, I'd have made 6.12% on average. You take the difference between those two numbers, 4.12%. That's an arithmetic average, historical risk premium for stocks over bonds. That's basically what you're trying to do when you're trying to estimate equity risk premiums. You're looking to see the difference between what you'd have made on stocks and bonds. Now, I don't use historical risk premiums, and I'm going to lay the groundwork for why. Now, the way I described historical risk premiums, you're saying, well, if 10 people estimate, they must come up with the same number, right? Wrong. They can each come up with a different number, and here's why. See the table below my graph? Those are my estimates of equity risk premiums, historical equity risk premiums for the US. Keyword is plural, premiums. I have 12 different premiums. Depending on the slice of history I look at, I can go all the way back to 1928. I can go back 50 years. I can go back 10 years. I can look at stocks versus T-bills. T-bills, which are short-term 3-month bills, or 10-year T-bonds, short-term versus long-term governments. I can even compute averages differently. I can take 95 years of returns, add them up and divide by 95. Or I can look at what would have happened if I had invested $1 in 1928. How much would it be worth in 2022? A geometric average, a compounded average. You can already see why analysts love historical risk premiums. They can get away with using pretty much any number. In fact, my range in this table is anywhere from 4 to 13%, and I don't trust any of them. There are two reasons I don't like historical risk premiums. One is it's akin to driving 70 miles on a highway with your eyes on the rearview mirror, right? Your job is to estimate a future premium, not to look at the past. And when you look at the past and use a historical premium, you're making the assumption that things revert back to an average. Mean reversion is the fancy word we use for this. We assume things revert back to the way they used to be. You're saying, what's wrong with that? Well, that's true if the world under you is not shifting, right? Think about the bulk of the time period that I've used to get my historical risk premiums. 1940s, 50s, 60s, a very different global world order than the one we face today. So my first problem with using historical risk premiums is the world has changed and I don't feel comfortable assuming I'll revert back to a mean that I computed primarily from the last century. But even if I were okay with mean reversion, here's the second reason I wouldn't use it. When you compute an average in statistics, you're also taught to compute a standard error. It tells you how uncertain you are about your number. So let me use that with equity risk premiums. So I go all the way back to 1928. My average is 6.64%, but my standard error is 2.15%. If your statistics is a little hazy, you're saying, what does that even mean? When you make an estimate, it comes with a range. If you ask me, what is my range for the equity risk premium given 95 years of history, I'm going to take the 6.64%. I'm going to add 2 times the standard error. That gives me the outer range. That's about 11%. And I'm going to subtract 2 times 2.15%, which would take me back to 2.3%. So what I'm basically telling you is based on 95 years of history, the equity risk premium for the US could be somewhere between 2.3% and 11%. Good luck with that. And that's with 95 years of history. If you have 50 years of history, the standard error gets large. And we have 10 years of history, you might as well tell me nothing because the range is so wide. I've seen emerging market analysts often use 10, 15-year historical premiums. They need to review their statistics because that's extraordinarily dangerous to do. So you're saying, if you're not going to use historical premiums, what are you going to use instead? I'll offer you my alternative, and some of you, especially if you've been reading my posts or watching me, should be familiar with it. It's called an implied premium. I draw on how we compute expected return on a bond, and in turn, a yield to maturity on a bond. You know how we do it? We take the price of the bond, we take the cash flows in the bond, the coupons and the face value, and we solve for that discount rate that makes the present value of the cash flows equal to the price of the bond. So the yield to maturity is, I do something similar with stocks at the start of every month, and I do it for the S&P 500. At the start of 2023, the S&P 500 was at 3839.50. So let's say I bought the index. I bought the 500 largest market cap stocks in the US. I'm not going to get coupons, right? These are stocks. I'm hoping and praying that I'll get dividends, and increasingly in the US that I'll get some of my cash flows by companies buying back shares. Unfortunately, I can't tell you what they will be in the future, but I can tell you what they were in the last 12 months leading in. And you can, as you can see, those cash flows were 182, with about 2/3 coming from buybacks and 1/3 from dividends. Here's the final piece of the puzzle. The S&P 500 is the most tracked and followed index in the world. There are about a dozen analysts whose job it is to forecast earnings for the entire index. And at the start of 2023, they're forecasting a growth rate of about 6.4%. I've kind of smoothed out their forecast because they forecast out only 2 years, and then I have to fill in the rest. But basically, they're forecasting about 6.4%. I use that growth rate to get expected earnings and cash flows in the future. I'm almost home. I have what we pay for the index. I have my expected cash flows for the next 5 years. At the end of 5 years, I say, look, these are the 500 largest market cap stocks in the US. They can't keep growing at a rate faster than the economy. So I'm going to set them to grow at the same rate as the economy in nominal terms. That's going to be a tough number to estimate, right? 5 years out, how the heck are you going to get that? I'll give you the proxy that I find useful in estimating these future growth rates for the economy. I use my risk-free rate. Because embedded in a risk-free rate is expected inflation and an expected real rate. It's a market's attempt to forecast how will the economy do. I use 3.88% a year. I'm home because I take my cash flows, I have the level of the index, and I solve for the discount rate that makes the present value of my cash flows equal to the level of the index. Solve here is a loose word because I use the solver function in Excel. It makes my life easier. Otherwise, I'd have to do trial and error. I come up with an internal rate of return of 9.82%. You think, what does it even mean? If you bought US equities at the start of 2022 or start of 2023, you're expecting to earn a return of 9.82% given what you paid for these stocks and those expected cash flows. I'm almost home because I subtract out the T-bond rate from that, and I come up with an implied equity risk premium of 5.94%. Forward-looking, right? I've used expected cash flows. Dynamic, because every time the index changes, the premium is going to change. Now, you can take issue with my estimates, right? You can say, look, I think analysts overestimate earnings. You can go in and change my earnings estimates, make the growth rate lower. That'll make your equity risk premium smaller. In fact, if you go to the spreadsheet where I do this, I take different proxies for growth, different proxies for earnings. I come up with a range for the implied premium, but that range that I come up with is between 4.6% and 6%. The range is much tighter with implied premiums than with historical premiums. Now, this expected return and equity risk premium that I get that I back out of the market, I find to be an incredibly useful number to think about markets. In fact, take that 5.94% equity risk premium and 9.82% expected return we have at the start of 2023. One way to think about those numbers is to, the question we're often asked, are stocks overpriced or underpriced? You can reframe that question in terms of the equity risk premium and say, is my equity risk premium 5.94% too high, too low, or just right? If you tell me 5.94% is too low a premium, you know what you're telling me, that stocks are overpriced. If you tell me it's too high a premium, stocks are underpriced. And to give you some historical perspective on that premium, I've gone back to 1960 and computed the implied premium and the expected return every year. Let me give you some historical context. The average premium between 1960 and 22, this is the implied premium, is about 4.2%. 5.94% is much better. You're saying, but that's from the last century. If I take just this century, it's 4.98%. I'm still doing better with 5.94%. Even if you take just the last 10 years, 5.35%, I'm still doing better. So if you're making a case that stocks are overpriced, the equity risk premium is pushing in the other direction, right? You're saying, what about the expected return? At 9.82%, the expected return now on stocks now is higher than any year since 1996. In fact, you know what that expected return was a year ago? At the start of 2022, the expected return on stocks was 5.75%. You're saying that's absurd. I would never buy stocks with that return. Go take a look at your portfolio. I'm sure there are quite a few US stocks in there. You know why we settled for that absurdly low return? Because where were you going to go? The T-bond rate was only 1.51%. This has been the biggest change in expected returns in a single year that I've tracked over the last 62 years. No wonder we felt so unsettled during the course of the year. So this expected return becomes the number that you look at and say, hey, should I be investing in equities in the first place? But there's another place this expected return comes in. It becomes the hurdle rate you need to pass for something to look like a good investment. The hurdle rate has become higher. Investments have to work harder to beat it. And from a company's perspective, this expected return becomes the cost of equity. This is the hurdle rate that they use internally to decide what projects to take, what investments to make. So an investment that had a return on equity of 7% a year ago, when the cost of equity is 5.75% for the average risk company, is not going to pass muster at the start of 2023. Capital budgeting is going to become a lot more difficult with a 9.82% cost of equity. And to give you a sense of how much the game has changed, I computed the cost of equity for every US company. I do this for all global companies, and I'll talk about the rest of the world in a future post. But these are the cost of equities for all US companies. Median cost of equity, median company is 10.67%. There are companies out there, cost of equities of 7. And here's where the higher risk premiums play out differently. If you're a risky company, last year's increase in cost of equity was doubled. It was much larger. You felt the pain even more. So if you saw tech companies and risky companies getting marked down more than the market, there's a reason. Increasing costs of equity don't affect everybody the same because riskier companies get hurt more. For the first time in a decade, more than half of all US companies have double-digit costs of equity. It's been a long time since that was true. But before you freak out, remember pre-2008, this was more the rule than the exception. We're returning to pre-2008 times in cost of equity, at least for the moment. So let me close off this session by answering the big question. What do we think about stocks today? Rather than give you my perspective, I'm going to start by giving you what I call a market consensus view on the level of the index. What am I doing here? I'm taking the market consensus on interest rates, inflation, and what the economy and earnings are going to do, and value the S&P 500 on that basis. So I took analyst estimates of earnings because that in a sense is a microcosm of the market. I took the T-bond rate today and said, you know what, if that's what people expect the T-bond rate to be, because if you thought T-bond rates were going to be higher, collectively we all thought that T-bond rates were going to be higher a year from now, it'd be higher today. So 3.88% becomes the steady state risk-free rate, reflecting inflation of like 3, maybe 3.5%. And then I valued the index using the market's view on earnings, the market's view on rates and inflation. The value that I got for the index was 39.72, very close to the level of the index at the start of the year. In fact, for much of the last 2 weeks, the market's been between 3,800 and 4,000, which is where you'd expect it to be given where numbers are in terms of risk-free rates and earnings. Now, don't get too excited, because the market consensus is not magical. Markets change their minds all the time. In fact, there are 2 dimensions on which the market is going to get tested. One is what happens to inflation over the course of 2023. Because right now inflation is high. We've had a few good months where it seems to be coming down. But the question is what will happen in the future? Maybe, and there are some people who believe this, inflation is going to completely disappear. We're going to go back to pre-pandemic inflation numbers, 1.5% by the middle of 2023. It's an outlier view, but some people believe that. There are other people who believe that inflation is not just here to stay, but it will stay stubbornly high. Inflation of 4, 5, 6% for the long term. As for the economy, lots of talks of a recession, but here again there's divergence. There's some people who believe that the recession is going to come, it's going to be a steep recession. There are others who actually think we might escape. The job numbers look good, maybe we'll escape. And what I've done here is taken 4 scenarios, discrete scenarios, even though this is a continuum. So let's take the most favorable scenario. Inflation drops quickly back to pre-pandemic levels and we escape recession. I value the index. And I came up with an index value of 4311, which is much higher than where it is today. Remember, this is not an expected level. This is the level that I expect today, which means that you're going to rise from there. That basically would translate into an 8, 9, 10% undervaluation in the index. Then I took the least favorable scenario, where inflation stays high and we have a steep recession, the worst of both worlds. In fact, to account for the steep recession, I lowered the earnings from the analyst estimates in 2023 by 20% and 2024 earnings by 10%. And the index value that I got was about 3,200. It was more than 10% below today's value. It's about, so basically that would suggest markets are overvalued. And the intermediate scenarios where you get one good thing and inflation stays high but the economy doesn't go into recession, or inflation drops quickly but the economy goes into, you're going to get the intermediate numbers. Now, I'm not trying to confuse you by saying any number goes, but I'm saying your views on inflation and the real economy are going to determine where you end up in terms of thinking about what the index will be at. And this played out this year in a ritual that we see at the start of every year, where market strategists, the investment banks, give you their predictions for where the index will be at the end of 2023. So that's a 2023 forecast. It's not the 2022, but the 2023 forecast for the S&P 500. Now, I have to tell you, the track record for market strategists is awful. In fact, they're more perverse forecasters than consistent forecasters. But one thing I was looking at was the divergence across the forecast. And this is a year with more divergence on the forecast than most years. Strategists are disagreeing more than they used to. And I can see why. Because where you're going to come down as a strategist in the index is going to depend on how you think inflation and the real economy will play out. Now you might say, well, what should I do? First, don't do what the strategists are doing because really it's based on their views. Don't do what I'm doing because that's based on my views. Now, I've always believed to be a good investor, you need to take ownership of your own investment decisions. Put simply, you need to come up with your own views or have your own views on inflation and the real economy. Now, you're saying, what if I'm wrong? We're all going to be wrong. Don't let that stop you. I use my spreadsheet because once you have your views, you can convert it into an index value, and then that'll drive how you think about investing for 2023. The reason we outsource this decision is it allows us to blame other people. We can say Jim Cramer made me buy that stock. Warren Buffett made me buy that stock. That's not healthy. We need to make decisions and hold ourselves accountable for those decisions. And this isn't rocket science. Everybody should be able to do this as long as they have a little bit of courage. I hope you found this session useful, and I thank you for listening.